interview, I want to share why this conversation matters. A few years ago, as a primary caregiver and financial power of attorney for a friend's aging parents, I had to figure out how to fund sudden 24/7 care. I explored every possible situation and option out there, including reverse mortgages, which is what we're going to be talking about today. Because in a crisis, you need to understand what financial tools are actually available. Whether you're planning ahead or navigating some kind of urgency or crisis, knowledge is so much power in these situations. And today we're talking about one of those tools with Carol Demarco, who lives here in Jacksonville, Florida. She's of Fairway Home Mortgage, and she's got a lot of important information to share. So let's get started. Hi, and welcome to Grand Plans Season 4, Episode 4. And before we get into today's conversation, I want to start with a little bit of my story. A few years ago, as many of y'all know, I found myself as the primary caregiver and financial power of attorney for a good friend's aging parents. And what began as like a little bit of help kind of morphed quickly into 24/7 care. It was expensive and it was ongoing. And my thoughts were, how am I going to pay for this? So when you're in crisis mode, some of those financial decisions feel very urgent and heavy. You're not just managing money, you're stewarding someone's life savings, and it feels very hard and like you're not doing the right thing. But I remember sitting at my kitchen table, reviewing things and trying to figure out what resources financially were available to this situation. And one of the things I thought about upon someone's suggestion was reverse mortgages. And I know there's a better term for that and something that not many people know about. But on the by and by, and after all of this finally settled, I was reintroduced to Carol Demarco, who I many moons ago served on the board of Girls Inc. with. That was a long while back.
Long time, yeah.
Yeah, now I'm happy to be with Carol today. She is going to tell you a lot about what she does, but Carol is a branch business development specialist with Fairway Home Mortgage. And we're going to get into some of the statistics and data points around reverse mortgages, what they are. And so, Carol, thank you for being here, and take it away. Let's get into it. How did you find yourself in this business? And I know the statistics show that we all ought to be thinking about reverse mortgages and all the financial options available to us.
Right. Well, thank you so much for having me on today. I just think that what we're talking about here is so critical for so many people, and yet they don't know how it can be such a great tool for them. I was in the mortgage business for 30 years, and I retired in 2013, and I've done a lot of stuff in the interim, but about a year ago, I started reading more about the HECM loan. That stands for Home Equity Conversion Mortgage, which is the new and improved name of the new and improved reverse mortgage.
Okay.
And I just realized how great a tool this could be in planning one's retirement and taking care of our quality of life as we get older. So I came out of retirement to do marketing with Fairway for this one product. Because I feel so strongly about it. So I am strictly in marketing for this. So my job is to educate as many people as I can about how safe this product is, the way that they can be used, and to hopefully help them out. And we've certainly been successful in doing that. So that's how I got into this. Fairway last year was the biggest retail originator of the HECM loan. There are others that are more wholesalers, but we are boots on the ground doing this. So we know what we're doing. And here's one thing that's critical. Fairway has a complete department that does nothing but HECM loans. So there are other lenders that offer HECMs, but they just go in with all the other mortgages. And when you get an underwriter that's underwriting a VA loan in 1 minute and then this lands on their desk, it can be a bit of a challenge because this loan is underwritten in a different way. It's much more generous in its underwriting guidelines. So I came out of retirement because I feel like it's so critical as we get older. There are 10,000 people a day turning 62 years old in the United States.
Yeah, let's talk about the demographics. I know that the 65 plus population is expanding rapidly. Are you seeing the same kinds of trends in your line of work?
It's crazy. Yeah, we have people of our age, and I'm older than you are, but people of my age, we are really the ones that have the money and are buying right now. You know, I mean, younger people are just not that interested in buying homes and whatnot. So we're the ones with billions of dollars in equity in our homes. And our generation has always been, get your mortgage paid off, have as much equity as possible. And that's not a bad thing. But as we all age, and there's, as I said, you know, there's millions of us that have lots of equity. And now we're facing things such as in-home health care. Maybe one spouse has to go in for some assisted living or some institutional care, something like that, but the other one doesn't. So that's how this can come into play. Other things that people of our generation is we're looking at now, maybe we've lived in our house for a while, built up that equity, and now we need a $20,000 roof. Well, you know, with insurance companies, especially we're in the state of Florida, you know, I mean, roofs are very expensive and insurance companies are requiring those. Things like making your home that you live in now more accessible. Maybe you need to have some wider doors put in. You need to have wooden floors put in. Just all kinds of things that makes a home more accessible as we get older.
Right. And aging in place is what everyone wants to do. I think the number is 85% or something. It's a big number of people who want to stay put as they age, which is a great thing. But tell me about how an HECM, how that can help a person stay in place. All of these scenarios you mentioned, you know, we're all aging if we're lucky. We have needs in our own homes as we age. How can this kind of loan help a person? What is it to begin with? Let's get into what it is and how it can help.
Let me be very clear about one thing. The HECM loan is a mortgage. It's like any other mortgage you get, whether you get, you know, conventional, an FHA, a VA mortgage. It is recorded in the same way. It goes, you make an application, you have to verify some information about yourself, and it goes into an underwriter. It is approved. You go through a closing, and it just put in place. So it's no different. There used to be, you know, the bank. I don't really even know if this is true, but way back in the day, the bank had to go on your title with you. Well, no longer. Just like, again, like any other mortgage, it's treated just like any other mortgage as far as how it is placed on your property. So you go through this process, and the big thing about this is that this is an FHA insured loan that a lot of people don't realize. So FHA has put so many guardrails on this loan, like it does its own regular FHA loan, that the consumer is so protected with this now. And people have heard all these terrible things about the loan in the past. May have been true in the past, not today. So FHA insures this loan just like it does any other FHA loan. So we go through the process. The biggest thing that FHA has put within these guidelines is this. Number one, you have to be, the youngest borrower has to be 62. Let's just say there are exceptions to that, but let's just say that that's the guideline. So the borrowers have to be 62. If one borrower is 72 and one of them is 62, the borrower who is 62, that age drives the amount of loan that you can get on your property. So they have put in age limits.
Okay.
And the reason they do that is the younger you are, according to actuarial tables, the longer you might stay in the property. So the older you are, the more you can take out up front, right? The younger you are, if you're only 62, you might not get as much if you were 72 or 82, something like that. So you would be able to have access to more equity the older you get, because the chances are you won't stay there as long. So you go through the process. Let's say you're 65 years old. The most loan that you can probably get, and it depends on your age, the value of your property, and the interest rate in the market right now. So it looks like you're going to get it at 70, let's say 70 years old. You're probably going to get somewhere around 40%, around there, 40% of the value of the property. So if the property's worth $400,000, you would be looking at a loan of about 160. Now these are just rounded off numbers. But by doing that, you're safe that if you can live in the property another 20 years and not have any issue. Now, once the loan is closed, you have options. You can take the loan as a lump sum with some restrictions. If you have things that you need to do around the house, you can get all that. You can't just take all of that money in cash day one. And again, that's a protection from FHA because they don't want seniors getting defrauded. Maybe a grandchild or somebody wants all that money up front. So they have to graduate it up for that first year. But you can set it up as a regular income. You can add to your income every month. That's a great thing to do. Mm-hmm. You can you can take out the money to do repairs. That's a great thing. You can also, if you have a mortgage on your property and it fits within those numbers, you pay that off. So there's a lot of things, and you can do a hybrid as also. You can take a lump sum, then you can set up as a monthly stipend. You can do all of that. And there's many, many ways to do that. So here's the crux of how the loan works. Okay?
Okay. You
get an amount. Let's just say that you are able to take out $100,000 at the table. Mm-hmm. You're able to take a check away to go do repairs or whatever for $100,000. All right. Here's the beauty of this product. You are not required ever to make a mortgage payment for the whole life of the loan. You're not required to do so. You can. Mm-hmm. You can make a payment, but nothing's free though. So every month there's interest due on the outstanding balance, right? Just like any other mortgage, right?
Right.
Except you are not required to make that payment. So it helps with cash flow. It helps with just quality of life, peace of mind. So, you're not required to make that payment.
Right.
What happens to that interest? And here's the crux.
Yes. Do you still own your home? How does that work with?
You absolutely own your home.
Okay.
As I said, it's like any other mortgage. They have a lien on your property.
Right.
You get any other mortgage, they have a lien on your property. So it's exactly the same. Mm-hmm. Your name is on the title no matter what. Their name, the bank's, the lender's name is just on the note and the mortgage that is now against your property, like any other mortgage, right?
Right.
So now you have interest due on the outstanding balance, right? So that interest, you can pay it if you want, but you don't have to, is now added onto the loan balance. Not the maximum you can get, but the outstanding balance.
All right.
So that interest is added on month by month, and you have got the benefit of using the money as you see fit. And yes, the difference between this loan on a regular mortgage, you make a payment, your balance does what? It goes down a little bit, right? Mm-hmm. With this mortgage, every month the interest is due. What happens to this balance? It goes up a little bit every month. Okay? So this is the crux of the loan. You're not required to make a mortgage payment. The interest due is added on top of your loan amount. And the reason that FHA has decided that you're going to start out at a fairly low loan balance is because you would have to live in that house, I don't know how many years, before you ever get close to what the value of your property is. Right. So not only is that balance going up, but over time, what else is happening? Always property appreciates.
Right.
The value of your property goes up over time. At any point in time, it could take a dip. Yeah, it could. But over time, the value of your property always goes up.
Right.
And so, yes, you are employing your equity in your property that you've worked so hard to build to work for you. You are employing that equity to pay for itself so you can have a better quality of life, right. Whether it be in-home health care, You need to do repairs on your home that you don't want to have to drain your income producing asset for. You want to travel. That's okay too. Your car's falling apart. You need a new car and you don't want a car payment and you don't want a mortgage payment. We can do that.
Right.
You want to get rid of this mortgage payment that you have that's weighing you down. This could help with that.
So, Carol, one thing I'm not hearing about just yet is the impact on heirs. As someone is aging and, at the end of the day, what are heirs left with? Because that's, of course, a big part of someone's estate is their home.
Big part. Mm-hmm. Great question. When a person that has a HECM loan, when they pass, their property passes to their heirs like with any other mortgage.
Okay.
Nothing else changes. The only difference is there may be less equity that the heirs are going to get. So if they started out, let's say the property's worth $300,000, the balance on the HECM loan is $150,000. That $150,000 goes to the heirs just like if there were any other mortgage on the property.
Right.
So it doesn't impact heirs in any way except this equity has been employed to take care of their parents or whomever is, the heirs, however they're getting the property.
Right.
So it's either they're going to drain their income producing assets to pay for in-home health care, which is very expensive. Mm-hmm. Or we're going to let this bucket over here, this equity in their property, do that for them and leave their income producing asset over here. So when heirs say, well, I'm losing my inheritance, what if they had to take it out of this bucket, which is their income producing cash?
Right.
If they're lucky enough to have that.
Yep.
And I get that either. Or the heirs are not having to have paid for mom and dad's health care.
Right. And let's just remind ourselves real quick that in-home health care costs $34 an hour on average. And that adds up very quickly, especially if you get in a 24/7 situation. So it's knowing about your financial resources and opportunities ahead of time can really make a difference in how you pay for that care when it's time. And it will be time. For 70% of us are going to need long-term care. And I know you've researched a lot of the statistics and use a lot of that data in your work. But tell me a little bit about how this current season impacts people, and what's the best time to plan for it? We know it's all coming. We know we're all aging. Is it? In my situation, I looked at a reverse mortgage or a HECM loan as kind of a last resort, and it was in the middle of a crisis, and I considered that as one option. But at the end of the day, it wasn't right for the situation. But is it better in that kind of situation, in a crisis, or are there ways to plan ahead for this as a financial tool?
Yeah, that's so critical. I work with a lot of financial planners who see the value of this, because when you take out a HECM, you do not have to take the money.
Okay.
By the way, you can let it sit there. Let's say your house is free and clear and you get approved for $150,000 HECM. You can let that sit there until you're ready for it. This doesn't expire. It's not like a home equity line of credit that expires or is called in 10 years. This can just sit there. So it's ready for you when you have this emergency. And the last thing that most people need to be dealing with in an emergency is this.
Exactly.
You have to go out and get it,
And the financial piece is, I think, the biggest piece of them all. You can't do all these things to help unless you have the resources to make it happen.
Right.
And it's a sad thing, but it's the truth. It
is so true.
Yeah.
And the financial planners that I'm working with, I just did one, and they were in their late 60s. They have a very large house on the river. They had some savings, but they're not wealthy people, and they needed to redo their roof.
Yeah.
And so we did that. We paid off their mortgage. We did the new roof. We did some new wiring in this house. It's an older house. And they're on their merry way. And now they also have about $1,200 more in cash flow every month because they don't have that mortgage payment. So, that's how it can work. And also, I've also seen people that maybe one spouse has to go into assisted living or maybe memory care. Memory care is so expensive.
Right.
And especially if it's memory care and only one spouse needs that, usually both spouses don't move into the memory care unit because it's so expensive or the facility. So we can use this money out of the home to help pay for that so that what's going to happen when that person in memory care does pass, the other one still has the assets that maybe they've saved their whole life for, so they have an income to live on for the rest of their lives.
Right.
So, that's so critical also. It's as we all age, my husband and I have one that we're not using it, but it is in place even when the time ever comes.
Right.
Or the time's going to come. And so we feel very, very comfortable in the fact that if it happens, then, we don't have to feel guilty that we're draining the other person's, income, nor that we're putting extra pressure on the other person because they're worried about, okay, here's my spouse who is ill or has to have in-home health care and they're aging, and now how are we going to pay for it? It's the best gift, I think, that a spouse can give to the other spouse. It takes the pressure off at a very bad time in their lives.
Yeah.
And I think that emotional gift is invaluable. I just think it's so important that we think about that up front.
I agree.
And there's a lot of other really great ways, and just a tiny, if you set this up front and you can set it up as if you're going to take the income, it's kind of set up like a home equity line of credit. That balance of that $150,000 grows over time. You're not going to run through it very probably. Right. So that's just something that's built into the loan. So it's a great benefit that a home equity line of credit does not have.
So what are the risks? I mean, if it sounds like it is a good way to be proactive in your planning, it sounds like it's a good way to be prudent in the way you're planning for long-term care costs and to cover needs. But what are the risks of this type of loan?
The one risk that I can think of, well, number one, you have to continue paying taxes and insurance like you do if you don't have a mortgage. Your taxes have to be paid.
Right.
We have a way to put that payment into this loan as well. Most people don't. So if you can't afford your taxes, then you have to really think about it. You're already in trouble if you can't do that. But again, like I said, we can just roll it into the loan if we need to.
Right.
Okay. The big thing that scares people, that just puts the brakes on things because of our thought process, is that having a property that's free and clear, having a mortgage paid off is the sacred cow. That's our generation and the generation before us. That was our goal in life. So we paid to get our mortgage paid off. And we've saved this other bucket over here that is our savings, for income production. All right. You are draining this bucket over here. So let's say you get the loan when you're 64 years old, let's say, and you were able, luckily enough, to stay in that property for 25 years. 25 years from now, and this is in generalities, but depending upon how you use that loan, depending upon if you use all the balance, depending upon if you ever do, you can use it, pay it, like a line of credit. Let's say you take the max out up front, and you're in the house for, let's say, 15 years. Conceivably, if your property doesn't go up any, which we know over time, real estate has always gone up, you could owe the balance on this HECM loan could have grown by adding interest on every month to more than what the house is worth now that you've passed away or you have to move out of the house or whatever. You could conceivably owe more than the house is worth at that time. That's the biggest fear. That's the biggest problem. That's the biggest negative about this loan. But here's the positive. Remember, this is an FHA loan. An FHA, I always say, is not stupid. They're not going to let that happen. So you the consumer, like any FHA regular loan, you have to pay for what's called mortgage insurance, private mortgage insurance that FHA charges. You pay that if you're on a first mortgage. You pay it. If regular mortgage, forward facing loan, you have to do it on that loan as well. You do it on the reverse mortgage as well. What that insurance is about is it insures the homeowner and or their heirs that if that does happen, you get all the way to where somebody has to sell the house, moves out, or dies, that if they owe more than the house is worth, they just walk away. FHA insurance kicks in. Now, like any insurance, you don't need it till you need it, right? But it kicks in, it pays off any negative balance, and nobody has to ever come to the table with money. Used to be you did, way back in the day. This is now a whole different ballgame.
Right.
So nobody, neither you nor your heirs, would ever have to come to the table with money. Plus, if that you do end up owing more than the house is worth at any point in time, and you're either moving out or dying or whatever, your heirs, not only do they not have to bring money to the table ever, they can buy that property for 95% of the value at that time. So if they want that house, they can buy it for 95% of value that is maybe lower than market. You just don't know. But right. 95% of the value of the property at that point, they can buy the property. Anything over and above, that's gone. Right. So the heirs, it's a win-win-win. The owners of the property never have to bring money to the table. The heirs never have to bring money to the table. Then the heirs can buy the property at 95% of what the property is worth at that time. So the only negative that I can think of is that if you live in the property a long time, which is not a negative, but if you do, you could owe more than the property's worth at that time. If you do, the insurance kicks in and takes care of it. So
yeah, that's
the negative in my opinion.
Not a very big negative.
Well, you're protected. It just mentally,
right.
It's a mental thing. Oh my gosh, yeah. Well, you're protected. Just like if your house burns down, you could go, oh. Yeah. If your house burns down, your insurance is going to pay for it. So right. Like I said, you don't need insurance until you need it.
Right. So what I'm hearing is this type of loan is for helps with many different situations at many different times of life, and is maybe best applied ahead of time when you can think clearly through it. But before I ask you to comment on that, I want to go through quickly some of the statistics you shared to underscore why everyone should consider or at least be knowledgeable about this type of loan as we age and take care of ourselves, our adult children, and the older adults in our lives. So a few things from AARP: 61% of caregivers are women. So, and 90% of them are unpaid. And I saw another statistic that said 1 in 4 of us, period, no matter your gender, are caregivers. So that's a lot of people. That's most of us. 40% live with their care recipient. 29% are sandwiched between children under the age of 18 and an adult family member or friend. That's a big one. 55% of caregivers take on medical or nursing tasks, which is expensive and hard. 24% of caregivers provide 40 or more hours of time per week. That is another big one.
Yeah, it's huge.
And 70% of caregivers are employed while providing care. So in addition to 70% of us needing long-term care, 70% of caregivers are employed while giving that care. So it's a big population of people that are impacted. And the more we know about how we cover the costs of this, the better off we all are. So is there anything you want to end on that note?
I do. I think that this, we were talking about the negative of it, which we need to talk about completely. But there's also a lot of really positive things. Let's just say you've got all the equity in your house, and maybe you don't need in-home health care, but what if you want to send your grandchildren to college?
Right.
And maybe you don't want to give up that $40,000, $50,000 out of your savings liquid account over here.
Right.
Why don't you use this to send your kids to college?
Right.
Maybe you've always wanted to go to Europe and you just can't pull the trigger to, really spend that much money. Do that for a while.
Yeah.
Things like, home improvement, like we talked about.
Yeah. And home improvement is not just, I want to make my home pretty and fancy. No, we want to improve it to make it more mobile and accessible. So
here's one other thing, and then I'll let you finish up.
Yeah.
But this loan can be used for a purchase as well. And most realtors and people don't realize this. And let me give you an example. Let's say somebody sells a house up north and they have $300,000 cash. They have their retirement income set up that does not include a mortgage payment, right? So they come down here with $300,000 cash and they can't find anything close enough to their grandchildren or whatever. So maybe what we could do is have them go ahead and put that $300,000 down and put $100,000 HECM in first place. They still don't have a mortgage payment, but they found a house that they like better by doing that. And the other thing is, what if they had $400,000, let's say, and they find something for $300,000? Let's just flip that. Instead of having them or find something for $400,000, instead of having to use or choosing to use all that $400,000, why don't we put $300,000 down, put $100,000 HECM on the property, still no mortgage payment. Take $100,000 of that money and put it in income producing. Put it in the retirement account. Let's preserve assets as much as we can, because we got a long time to live.
Mm-hmm. We do. 100 years, I think, is the average now.
Yeah,
for what people are planning for.
Yeah, I know. So that's really what I'll end on. I think it's a very positive thing. And I know that there's been a lot of fear mongering about it, and especially, sometimes heirs get real worried that their parents are going to lose their house. No, they're not. Mm-hmm. They're not. This is so protected now. And so I just want to dispel as many of the myths that I can. And I would love to talk to anybody that wants to, email me or I'd love to, I can meet with people. We can have a lunch and learn, whatever. I do it all the time. So,
Carol, if someone wants to learn more about a HECM loan, where can they go? And I know you have some resources available to folks who want to learn more.
My email address, can I give that?
Yes, please.
Okay, my email address is Carol, Carol, Demarco, Demarco, at Fairway, FAIRWAYMC.com. Drop me an email and I will get back with you and talk with you if you will. I have a book. It's called Understanding Reverse. That's from my company. I have a number of these in my home. And if anybody wants one, just reach out and I will drop one in the mail to you or meet you and give you one or the other. Just, email me. We'll set up a chat and, we can go over it. No pressure. I don't originate these loans. All I do is educate. Mm-hmm. So there'll be no pressure. Yeah. And I know that it's scary sometimes to talk about the precious equity that you've worked so hard to do. And believe me, I get it. Yeah, I've worked hard to have equity too. So, I'm of an age that I can relate to whatever you can throw at me. Yeah. I've done it. So let me help you either save your home, save your mental state.
Yes.
And help you be more comfortable in your retirement time.
Yeah, Carol, you're such a professional and such a wealth of knowledge about this loan, which, many people just don't understand or haven't been in the position to even think they might need it. So thank you for sharing your knowledge of this product and just talking about the situation in general. It is something all of us face at some point in our lives.
Thank you so much. And what you're doing is so helpful. The articles you write, having this podcast, this is what we need to do. Yeah. And I'm happy to do it with anybody, for anybody, whatever. I'm so passionate about this.
Oh, well, Carol, thank you for your time today. And hope to see you soon. Thanks.
Me too. Just reach out anytime.
Thank you so much for listening to Grand Plans. In today's conversation, we talked a lot about some complicated financial products. But if it sparked new questions about your own financial future, that's a super good thing. And clarity, it's a winner for all of us. It creates calm, and calm creates better decisions in the end. So share this episode with someone who needs to hear it. And as always, keep planning thoughtfully, talking openly, and designing your next chapter with intention. I'll see you next time.